Hey everyone, welcome back to Corporate Decoder. Today we have Lake Superior Acquisition Corp and their annual report, and let me tell you, this filing is a bit like a SPAC finding its target. There is a lot of talk about future plans and a whole lot of numbers to sift through to see if they're actually getting anywhere. Stick around to see if this company is just a placeholder or if it's ready for action. Before we dive in, if you like getting clear, no nonsense breakdowns of these filings, make sure you subscribe and turn on notifications. Also, we've got a fantastic community over on Discord, so jump in using the link in the description to keep the conversation going. So, Lake Superior Acquisition Corp is what we call a SPAC, a special purpose acquisition company. Think of them as a company with money that goes out looking for another company to buy, to take public. They are basically a shell waiting for a good merger or acquisition to happen. It is a pretty common way for companies to go public these days, but it comes with its own set of risks, especially for investors. Their sponsor is a company called Lake Superior Investments LLC. The person behind it, Edward Kong Wang, has experience with other SPACs that have already merged with companies. He has been involved in deals before, and that experience is supposed to help Lake Superior Acquisition Corp find a good target. They believe their sponsor's network gives them an edge in finding and sealing a deal. Now, here is where it gets interesting. As of the 31st of December 2025, this company, Lake Superior Acquisition Corp, basically had no operations and no revenue. They are a blank check company, meaning they exist to buy another company. They went public in October 2025, raising quite a bit of money. The initial public offering, or IPO, that is the initial public offering, brought in over $115 million. On top of that, they had a private placement of additional units, bringing in another $3.6 million. All this money, over $115 million, is sitting in a trust account, sort of like a holding tank, until they find a company to buy. Speaking of that trust account, as of the 31st of December 2025, it held over $116 million. This money is meant to be used for the business combination, but it is also a safeguard for investors. If the SPAC doesn't find a company to buy within a certain time, usually 18 months, that money is supposed to be returned to the shareholders. Looking at their finances for 2025, they reported a net income of about $666,000. Now, this doesn't come from any business operations because they have none yet. This income is actually just interest earned on the money they have in the trust account. So while it looks like profit, it's really just the bank paying them for holding their money. They did have general and administrative expenses totaling around $360,000 for 2025. These are the typical costs of running a company, like legal fees, accounting, and administrative support. These costs eat into the interest earned from the trust account. Remember, this is a SPAC, so they are burning cash just to stay afloat and look for a deal. Now, about those shares, they have Class A and Class B shares. The Class A shares are the ones sold to the public. A big chunk of these, over 11.5 million shares, are considered subject to redemption. This means those shareholders have the option to get their money back, essentially around $10.09 per share if the SPAC doesn't find a deal. Then there are the Class B shares held by the sponsor and some insiders. They bought these for a tiny fraction of a cent per share, which is a pretty sweet deal for them. These shares convert to Class A shares when the SPAC merges with another company. This brings us to a key risk factor, conflicts of interest. Because the sponsor and insiders bought their shares so cheaply, they have a huge incentive to get any deal done, even if it is not the best deal for the regular shareholders. They make their profit from the initial cheap shares, while public shareholders might lose money if the deal isn't great. This is a common SPAC problem, where the people running the show can profit even if investors don't. A major risk for any SPAC is time. Lake Superior Acquisition Corp has only 18 months from its IPO, which was in October 2025, to find and finalize a business combination. If they fail, they have to shut down and return the money in the trust account to shareholders. This time pressure can force them to accept a deal that is not ideal, just to avoid liquidation. And here is the big news for Lake Superior. On the 23rd of January 2026, they announced a deal to merge with Open Markets Group Pty Ltd, an Australian company. This is their target. The deal involves complex steps, including mergers and contributions of shares, with a plan to eventually merge and liquidate the existing SPAC structure. The initial plan is for the seller of Open Markets Group to receive about 30 million shares of the new company, valued at $10 each. There is also a potential for another 70 million shares based on future performance milestones. This deal has to satisfy certain conditions. A big condition for this merger to go through is getting shareholder approval. If enough people vote no and want their money back, the deal could fall apart. This is where that redemption right becomes a real factor. On top of all this, the regulatory environment for SPACs has become more complicated. New rules from the SEC mean more disclosure, more scrutiny, and potentially higher costs. This new landscape can make it harder and take longer to get these deals done. One more thing to keep in mind is where this company is incorporated. It is in the British Virgin Islands. While that might offer some tax or legal advantages for the company, it can make it tougher for investors to protect their rights or seek legal recourse in the United States if things go wrong. So, what's the bottom line here? Lake Superior Acquisition Corp has found a potential partner in Open Markets Group. They have the money from the IPO sitting in trust and a plan to merge. However, they are still an early stage company with no real business operations on their own. The success of this venture hinges entirely on this upcoming business combination. The risks are pretty standard for SPACs, the time limit to find a deal, potential shareholder redemptions that could drain cash, and the inherent conflicts of interest from the sponsor. The fact that they've announced a deal is a positive step, moving them from just looking to actually trying to combine. But the devil is in the details of that merger agreement and of course whether shareholders ultimately approve it. Without a successful business combination, investors could simply get their original $10 back, minus fees of course, and those rights they got would just expire worthless. It is a gamble on the management team's ability to close this deal and for Open Markets Group to be a solid growing business post-merger. Alright, that is our look at Lake Superior Acquisition Corp. What do you think about their announced merger and the SPAC model in general? Let us know in the comments below. If you found this breakdown helpful, smash that like button and subscribe for more deep dives into corporate filings. And don't forget, our Discord community is the place to be for more in-depth discussions, so join us through the link in the description. Thanks for tuning in to Corporate Decoder. See you next time.